G'day traders, today I want to speak about Keltner channels or Keltner Bands. What are they, where do they come from, and what do they do? Now before we get started, I just want to mention that I recently set up membership for the channel. It's a really cheap membership plan. If you're not interested in my courses but you want to support the channel and want to help me continue creating content, that's one way to do it. Members get priority responses to comments, so I promise to reply to any member comment. I can't give financial advice, but if you have a video idea or a question, I'll answer it there. And you will also get access to any new video I make at least 1 week in advance. Obviously, don't need to sign up, but if you like my work, that's one way to support it. Thank you guys. Appreciate it. None of the material in this video is financial advice. Everything I do in these videos is purely to demonstrate coding techniques, and the code I write is purely for example purposes. You should always do your own research and due diligence before engaging in trading or investing, and please seek professional guidance if you need it. With that said, let's look at some code. So Keltner channels are volatility-based envelopes set above and below an exponential moving average. This indicator is similar to Bollinger Bands, which use the standard deviation to set the bands. Instead of using the standard deviation, Keltner channels use the average true range to set channel distance. The channels are typically set to average true range values above and below the 20-day EMA. Keltner channels are a trend following indicator used to identify reversals with channel breakouts and channel direction. Channels can also be used to identify overbought and oversold levels when the trend is flat. Where did Keltner channels come from? So in his 1960 book, How to Make Money in Commodities, Chester Keltner introduced the 10-day moving average trading rule, which is credited as the original version of Keltner channels. His original version started with a 10-day SMA of the high-low close averaged as the center line, and the 10-day SMA of the high-low range was added and subtracted to set the upper and lower channel lines. That is what I have on my chart right now. So if I bring up the Pine editor, let's just focus on this code here. So here I'm getting the SMA of the high-low close averaged, so high-low close divided by 3, over the past 10 bars. I have a multiplier input here. It's set to 1 by default. So by default, the moving average band is 1 multiplied by the SMA of the high minus the low. This gives us the high-low range over the past 10 bars. Then we simply add the moving average of the high-low range. We add it to the central moving average and subtract it from the central moving average to get our lines, our channels. And then we just plot them onto the chart. Then I have some extra code here which calculates the percentage number of bars which trade above or below these channel bands. And as you can see on SPY, the S&P 500, we have significantly more bars trading above the band than below the band. And this is on daily bars going all the way back to February of 1993. So pretty reasonable sample there. And this obviously adds to the evidence behind the concept or idea or phenomenon of equities tending to trend upwards more over time than they ever trend downwards, or they spend more time going up than they do going down. I mean, that's a pretty commonly known phenomenon. I don't know if you can even call it a phenomenon because it's just a function of growing economies and inflation. Companies generate value over time. They tend to, unless you're in a country where things are not going very well. If you're in a booming economy, companies are generating value. Their stock prices tend to go upwards over time. There are periods of time when they don't go upwards. We are all very familiar of those times. And if we go on the monthly time frame, we have 44% of bars trading above our upper channel and only 6% or 7% of monthly bars trade below this channel. Now the channels are now 10-month moving average based. But anyway, I just think that's very interesting and I wanted to point that out. And by the way, I'm not saying you should go out and buy SPY or the S&P 500 because of this. I just wanted to point out that I think it's interesting. Even if we go to the equal weighted S&P 500, this, as we all know, the SPY S&P 500 traditionally is heavily weighted by tech stocks at the moment, especially quite heavily weighted. I think it's like 40% of the S&P 500 performance is made up by 10 stocks. But if we go to the equal weighted S&P 500 ETF, where there is no weighting and the price is based on the equal weight of all the members, you can still see that phenomenon where bars which trade above the upper channel tend to occur far more often than bars going down below the channel. Now, as I said, we often see far more volatility to the downside than the upside, but the time spent below these lower bands tends to be quite a lot less than above the bands. And I just find that really interesting. So as I said, this is not Keltner channels right now on my chart. This is the original Chester Keltner 10-day moving average trading rule channels. Let's have a look at the modern day interpretation. So the modern day interpretation of Keltner channels is from Linda Raschke, who was featured in Jack Schwager's New Market Wizards book. Back in the 80s, she invented a alternative version of Keltner channels, which, like Bollinger Bands, uses a volatility-based indicator, the ATR, to set channel width. So this indicator is using the 10-bar moving average of the high minus the low, added and subtracted from our central moving average. The traditional modern-day Keltner bands work slightly differently. First of all, they use an EMA instead of an SMA. And second of all, they use the ATR value instead of the high-low range moving average. So if I zoom out here before I save my script, keep an eye on the upper and lower bands. And before I do that, the default value for modern day Keltners tends to be 2 times the ATR from the central moving average. So let's update our default user input value and save the script. Keep an eye on these bands. You can see now that they've smoothed out a little bit and they have a bit more dynamic range in the distance that's occurring here. By the way, if you find this lesson interesting and you want to learn more about Keltner channels or Bollinger Bands or any of these types of coding techniques, check out my PineScript Mastery course, where I have a bunch of lessons on Bollinger Bands, Keltner channels, and ways to implement the ATR into various indicator functions. I also just realized while editing this video that I forgot to update the look back to 20 bars instead of 10 Keltner bands with the traditional default indicator conditions and parameters. They use a 20 EMA look back with the 2-band multiplier. That's what this looks like. And going forward, that does change some of the numbers which I speak about. For example, as I said earlier, with the original Keltner 10-day moving average trading rule, whatever he called it, we get nearly double the number or percentage of bars above the upper band than we get below the lower band. And we see that exact same structure even with a 20-period EMA-based Keltner band using the ATR for channel distribution. So again, just find that really interesting. Right now, I am on the equal weighted ETF. Let's have a quick look at SPY. Way more pronounced on SPY for whatever reason. Let's look at Russell 1000. You can see this is a pretty broad phenomenon, even on Aussie equities, British equities. It's just a really interesting thing to visualize and see. It has a lot of implications, which I won't go into today. As always, the source code to this script will be linked below if you want to go and do your own research and your own study on this concept. And on that note, any links below may be third-party links that I get a commission at no extra cost to you if you use them. Just another way to support the channel if you are so inclined. And if you are so inclined, I am inclined to thank you. Anyway, let's move on. If you're not familiar with what the ATR or average true range is, it's basically a volatility metric. It is the range of price action based on the current high minus the current low, which is what we were using before, a 10-day moving average of the high minus the low. But the ATR adds a couple of other conditions into it. It is also the absolute value of the current high minus the previous close and the current low minus the previous low. So whatever is the greatest of these three values is taken as our true range value, and then the ATR averages these values over typically 14 bars. And that's what we have here. We have a 14-period ATR and we are multiplying it by our user input, and we are adding and subtracting it to our central moving average, which is now an EMA instead of an SMA. And for those of you who are newer to trading, if you're not familiar with what an EMA is, it's basically an enhanced version of an SMA. Well, it's not necessarily better, but it's a little bit more fast to react. It's a quicker reactive moving average. It emphasizes recent price points or data points more heavily, offering a crucial edge in tracking price dynamics. I don't know about that. It doesn't necessarily work better than an SMA. It's just a different way. People have different preferences. I do tend to prefer the EMA. I just think it makes a bit more intuitive sense to weight more recent data points in a data set, but that's a personal preference. It doesn't really matter. You could just as well use an SMA for a Keltner channel. And if we save this script and zoom out, you're going to see basically no difference. So this is what the traditional modern day Keltner channel looks like. It's a 2-period ATR added and subtracted from a central moving average. If we scroll down to interpreting Keltner channels, indicators based on channels, bands, and envelopes are designed to encompass most price action. Therefore, moves above or below the channel lines warrant attention because they are relatively rare. That's what you would expect to see with a 2 ATR band. Now you can see that we are really capturing outliers here. And if we were to add to my code here, we could add a couple of BG colors here. We could add BG color close above upper channel upper question mark color.new color.green with 50% transparency, otherwise no color. I copy that, flip this and say lower channel, set this to red. We are now going to be highlighting when price is above or below these bands. And if we zoom out, you can see how rarely that happens. Before I move on, I'll change this to channel break above and pull that out. And channel break below equals close minus channel lower, and move this down here and this down here. And now we have a couple of Boolean values we could check. If channel break above, you could add a strategy function here to enter or exit test trades or whatever you want to do to see how these indicators affect strategy ideas. But for now, I'm going to leave this as this. There'll be a link to this simple template example code below if you're interested. If you want to be really specific, usually channel breaks are based on the previous bar's channel so that you're not incorporating the current bar's movements into the calculation of these channels, or even do it up here. Here's an example of Bollinger Bands and Keltner channels being drawn over the top of each other. As you can see, they're pretty similar. It depends on what you're trying to achieve. If you care even more about those outliers, maybe a Bollinger Band's better. If you're looking for a more consistent, smooth channel for something like a trailing stop then maybe a Keltner channel would make more sense. As always in trading, there's no best tool. There's just various tools to apply to various tasks. Anyway, with that said, I'll wrap this video up here. As always, the source code to the script will be below, and I'll speak with you in the next one, guys. Take care. Good luck out there. Stay safe. Be good. And don't forget to subscribe.